Hello traders, you're welcome back to the Forex Geek channel. Now, swing trading is one of the best ways to take advantage of market movements without being glued to the charts all day. So if you are new to swing trading or looking to refine your strategy, then this video is for you, okay? In this video, I'll break down everything you need to know about swing trading, from key concepts to the best setups and risk management tips, okay? But before we dive in, don't forget to hit that like button and subscribe to the channel. It really helps the channel to grow, and you'll get more expert trading insights straight to your feed, okay? Now let's just start with the basics. Swing trading is a trading style where you aim to capture short to medium term price movements, typically holding positions for a few days to a few weeks. Now, unlike day trading, where trades are closed within the same day, swing trading allows you to take advantage of larger market swings. This makes it ideal for traders who want to actively trade but don't have time to sit in front of the charts all day. So it's also a great approach for beginners because it reduces the pressure of making rapid decisions. All right. The goal of swing trading is simple: identify trends, enter trades at optimal points, and ride the move until momentum starts to fade. Okay. Now, swing traders typically use higher time frames than day traders. The best time frames for swing traders are the 4-hour charts and the daily charts. All right. Now, these provide a good balance between signal reliability and trade frequency. Okay. Then, as for the weekly charts, it is useful for identifying major trends and support and resistance levels. Okay. So if you want to get the overall picture, right, the overall picture of the market, spotting important price levels, important support and resistance levels from the bigger picture, you can actually use the weekly time frame to spot that. Okay. And remember that the higher the time frame where you identify your key levels, the stronger the levels. Okay. For example, a support level identified on the weekly time frame is going to be stronger than a support level identified on the 1 hour time frame. Okay. And same with a resistance level. Okay. Now, let us talk about indicators. Okay. While price action is key, indicators actually help confirm trade setups. All right. Price action is key, but indicators help confirm trade setups. So here are some of the most effective ones for swing trading. Okay. The first are the moving averages. You can use the 50 EMA and the 200 EMA. This is a popular combination. It's a popular combination, right? This help identify trends and dynamic support and resistance levels. Okay. Then the relative strength index is another popular and important indicator. Okay. It is used to spot overbought and oversold conditions, helping you to time your entries and your exits. Okay. And then the next indicator is the MACD, the moving average convergence divergence. Now, this is actually great for spotting momentum shifts and trend confirmations. And then finally, the ATR, the average true range. It is used for setting stop losses based on market volatility. Now, using a combination of these tools can improve your decision making and increase the accuracy of your trades. Okay, now that we know the best time frames and indicators, let's just talk about trade setups. Okay, so here are some classic patterns that work well for swing traders. Okay, the first is the trend pullback strategy. So you have to wait for price to pull back to a key moving average, right? You have to wait for price to within a trend. For example, this is a sell trend, right? So you have to wait for price to pull back to a key moving average, for example, the 50 EMA, and then you enter when the momentum resumes in the direction of the trend. All right, so after the price pulled back to this 50 EMA, once the sell momentum increases, you can see the MACD giving us a signal, you can see the RSI giving us a signal. So once the continuation pattern forms, you can see this bearish engulfing pattern also, validated the continuation. And then you can enter a sell trade, right after the pullback has concluded. Okay, then as for breakout trading, you have to look for price consolidations. All right, look for price consolidations. It could be a parallel channel, when price is just moving in a parallel channel, as the name implies, or it could be a triangle pattern, it could be any other consolidation pattern, could be a flag pattern. Okay, so basically you enter when the price breaks out of that consolidation pattern, whatever form that the pattern takes, right? You enter after you have a breakout. Okay, so in this case, you can see that we initially had a breakout to the upside, and it just moved for a bit. So if you had entered this, for example, then you could have taken your take profit at the nearest resistance. You can see that there was a resistance zone. So you have exited your trade at the nearest resistance. Then finally, for the reversal trading, you can use the RSI or candlestick patterns, like pin bars or engulfing candles to spot potential reversals at key support and resistance levels. Okay, for example, we can see that we have a key support level around here, right? You can see that price was already getting rejected, and then you can pay attention to your RSI. You can see that RSI showed that bullish momentum was building up. In addition to that, you can see that we had a bullish engulfing pattern around here, so that validated this potential buy, and eventually we had price climb up. Okay, so the key to high probability setups is patience. Don't chase trades. Okay, wait for the right moment based on technical confirmation. Now, even the best strategy won't work without proper risk management. So here's how to protect your capital. You have to set a stop loss. All right, always define your risk before entering a trade. Okay, a good rule of thumb is placing stops 1.5x or 2x of your ATR value. Okay, then it's important to also use good risk to reward ratio. Aim for at least 1:2 risk to reward ratio, meaning you are risking $1 to potentially gain $2. All right, then with respect to your position sizing, do not over leverage. Stick to risking no more than 1 to 2% of your account per trade. All right, and finally, avoid over trading. Okay, swing trading is about waiting for the best setups. Okay, not taking trades just for the sake of it. All right, good risk management ensures that you stay in the game long enough to capitalize on the best opportunities. So before you start swing trading, watch out for these common mistakes. All right, the first is trading without a plan. It is very bad. Okay, random trades based on emotions usually lead to losses. So always follow a strategy. And secondly, do not ignore the trend for any reason. Trading against the trend can be risky. All right, If you have a sell trend, you should be looking for sell opportunities. If you have a buy trend, you should be looking for buy opportunities. Okay. And then do not hold trades for too long. Swing traders aim for short to medium term moves. Okay. Holding on to trades for months turns it into an investment, not a trade. All right. So avoiding these mistakes will help you become a disciplined and successful swing trader. Now that you've got a complete beginner's guide to swing trading, it's time to put this knowledge into action. Remember, success in trading comes from learning, practicing, and staying patient. If you found this video helpful, hit that like button. It really supports the channel. And if you want more expert trading insights, subscribe and turn on notifications so you never miss a video. Let me know in the comments, what is your favorite swing trading strategy? I would love to hear your thoughts. In the meantime, thank you for watching, and I hope to see you in the next video.